In this class, we'll start with partnerships chapter. Before we start, before we start, we have to understand this one. Income statement preparation, statement of financial position. So you have to be master with these two. You might have studied these two in your financial statements chapter, income statement as well as financial position statement. So if you are having only one person running the business, he prepares a income statement. Whatever the income he gets is transferable to his financial position statement as profit. But what happens, if we have multiple persons carrying on this business as partners, then what happens here? The profit what earned by running the business will be shared by different partners as per their contributions. In a partnership firm, assume that we may have three partners like A, B, C. A may support the firm out of his own financial power. He has good money with him, so he contributes more capital. And B, hard worker, he takes care of the business day long. And C has good connections with the people, so he can simply get the orders and he can sell the goods as he wishes. And the profit earned by the firm is now shared among the three parties as per their contribution. The person who contributes finance may demand some interest component because he might have invested this amount in banks. If he might have invested in the bank, he may get the interest. So instead of investing in the bank, he invests in the firm, means he may be compensated for his own support. So that is what about interest. Similarly, B may be the hard worker. So he could have worked somewhere, he may draw some salary. As he is contributing the physical work for the firm, he may demand some return for that, which is called salary. And the person who gives the connection, his personal connections for the business development, then what happens here? For the connection, he may demand some commissions like. So each and every partner will support the firm's development differently, and the net profit earned by preparing the income statement, what you calculated, will be given to all these three partners as per their own contributions. After this, anything left over will be shared by all the three partners, which is called profit and loss ratio. So net profit will be shared among the partners as per their own contributions given to the firm. After that, this will be added to the concerned capital account. Only then you have to prepare. So in case of a partnership firm, income statement and financial accounts, financial position statement, in between we need to prepare how the profit is shared among the three partners, will be called as P&L appropriation. Not only that, after appropriating, those amount will be added to the concerned partner's capital account. No, that will be prepared separately in capital account. So capital account along with the current account. Okay, along with the current account. Capital account will be the initial amount invested in the day one, and now and then there may be lots of amount credited in their account due to these reasons, and maybe debited for their drawings. Okay, for their drawings. So the drawings and interest will be again subtracted. So that will be shown separately in the current account. So you have to prepare this one before preparing financial position. So it's nothing but again final accounts only. Okay. So income statement you might have studied in financial statements chapter. The income statement is prepared before items 2 and 3 below. Income statement of financial position, otherwise balance sheet, prepared at the end after completing the above statements. These two chapters you can refer the financial statement chapter, so that you'll be able to understand this logic better. In between these two, you have to prepare step number 2 and step number 3. The step number 2 is all about profit and loss appropriation account. So how the profit is shared among all the partners will be shown here, which is called profit and loss appropriation account. Prepared after the income statement but before the statement of financial position, shows how the profit is distributed among the partners. This will be the main work we do here. And then we'll now move on to the partners ledger accounts. In partners ledger account, we have capital account and current account. So capital account is nothing but the opening capital balances. Okay, record only the opening capital balances. Whatever the amount we invested, the partner invested the day one remains as the opening capital and closing capital. We don't do any more adjustments in that capital account. Apart from that, all the appropriations are routed through current account like interest on capital and drawings, salary, commission, share of profit, etc. Understand? So these are the amounts are going to be recorded only in the current account. After that, the balances will be transferable to the financial position. Anyhow, as we study partnership, our focus is only the step number 2 and 3. Okay. Now, how should be the capital account? In case of capital account, we'll have only initial balance brought down. You don't need to do any more adjustments in this capital account. It remains the same year after year. And in case of current account, in case of current account, all other things will be appearing. We'll start with the balance brought down. So the partner will have a capital here, which is the amount invested in the business in the day one, or they want to maintain this amount remains unaffected, will be called as capital account. And whatever the additional amount they invest will be always changing now and then due to additional deposits and drawings from here, and any contributions given by the partners are compensated like salary, interest on capital and commission, and all will be addable. So some plus or minus will be always happening. This will be routed through current account. So in case of normal capital account, you prepare these two combined manner, but in case of partners capital account, it will be kept separately and the second part will be kept separately. It's a main capital, this is an additional capital, like you can understand. If the firm plans to enhance the original capital, then they can decide it. So until that period, this remains the same. Okay. What are the amounts are going to be credited here? The amount eligible for them as being the income will be credited like interest on capital, salary, profit share and all. And in case if they withdraw the money, it will reduce their balance. So drawings and interest on drawings should be debited in the current account, and balance carried on will go to the next page. Okay, next year. Usually current account will have the balance in the debit side as well as credit side. You will either have the balance in debit side or credit side, but in case of capital, you will usually have the predominantly you will have the credit balances. Is that clear? Now, how the P&L appropriation account will appear? Find out the profit for the year that you calculated from the income statement. You prepare income statement and arrive this one. From there, the partners are going to be shared. If the partners are eligible for interest on capital, give that first of all to the concerned partners and partners salary and commission. And if the partner has drawn, it is the reverse, right? If he has invested, then interest on capital will be there. If he has drawn, interest on drawings will be charged. So interest on drawings will be addable with the profit for the year, and this is the total income distributable or apportioned to the partners for interest on capital and partners capital and all. Even sometimes it may be for some commission and all. Whatever the amount left over, out of that profit and profit share will be distributed to the partners. So these are the three elements predominantly we have. What are they? Interest on capital, partner salary, leftover profit share. Okay, these things are going to be subtracted. And in case of interest on drawings, it will be predominant one item will be addable with the profit for the share, profit for the year. And apart from that, we may sometimes have the commission also, commission to some of the partners. Hope you'll be able to understand. In your current account, all this value will go to the credit side, this value will go to the debit side. So that's how you can easily remember in your preparation. Okay. And in case of financial position, that too the statement you might have studied in your financial statements chapter itself, but only one aspect is different, which is nothing but capital account. We have capital account. There we have only capital account with the opening capital plus profit, like you prepared there. Here, capital and current account, two capitals are there. In current account, opening balance and interest on capital, partner salary and profit share will be addable. Okay, and from there, drawings and interest on drawings will be subtracted. So this is nothing but the same. All these things are going to be, this is the first one, will be appearing in the balance sheet liability side. These things are appearing in the balance sheet liability side after adding these values. Okay, from that you have to subtract drawings and interest on drawings. So then you will be getting this financial position statement also for the capital. So rest of the other things like non-current liabilities and non-current assets and current assets will be appearing as usual. There will not be any complications. Let's now start with one illustration. Question number 1 here. Preeti and Paisley are in partnership renting out properties. Their intention is to rent out their own properties to generate the rental income. Paisley manages the office and maintains the bookkeeping records for the partnership. The partnership agreement provides for. So these are the agreement they have currently. Okay. Apart from that, partners provided the following list of balances. Initial balances also be given here. These are the balances as on the year end. What more? The profit for the year being 33,100. Profit for the year. So what to prepare? Prepare appropriation account and current account. So we'll start with appropriation account and current account here. Especially you have to prepare current account only for Paisley, not for both the parties. Okay. So we have Preeti and Paisley, but anyhow we prepare the current account only for Paisley. In case if you want to prepare both, you can prepare both in the same manner, right? Now, partners capital account. Okay. Paisley current account. Paisley current account. And this will be appropriation account. Appropriation account. Right. We start with the profit for the year. Profit for the year. That value being 3,300. And you have to add interest on drawings. Interest on drawings for Preeti and Paisley. Interest on drawings recovered at the rate of 5%. Drawings for the year ended 31st January 22 is given here. So on this drawing 5% will be calculated. Hope this will be 750. And similarly for Paisley 5% on this 650. Overall interest on drawings being 1,400 is added 34,500. Now you have to subtract less. So what will be deducted? Interest on capital for Preeti and for Paisley. Okay. Usually the interest on capital will be calculated on capital account balance, not the current account balance. So on that 4% and on this 4%, 4,800. 4,800. And we'll go for the interest on capital. The next one being salary payable. Salary is for Paisley only. Okay, Paisley. The value being 6,000. Value being 6,000. That's all. Now the total value to be subtracted here being 10,800. 10,800. You have to subtract these two. 23,700. This should be shared between the partners. The residual profit and loss to be shared in the ratio of 75% to Preeti and 25% to Paisley. So share of profit. Share of profit. Preeti and Paisley. In that 75%. Here 25%. 75% being 17,775. Here 5,925. Now we have to prepare Paisley's current account. Paisley's current account. In Paisley's current account, you start with a current account. This capital account not required. If you prepare capital account, this will be appearing. As we are not going to prepare the capital account, only current account. So especially Paisley details are going to be recorded. So balance brought down being 2,350 credit. If it is being the debit, then you have to post that in the debit side. Is that okay? And in case of drawings that should be subtracted, means it should be posted the other side. Here drawings. This value being 13,000. Now the addable item should be in the debit side and subtracting item should be in the credit side. So interest on drawings is the addable item. My focus is only Paisley. So Paisley's interest on drawings, here interest on drawings should be other side. Debit side, right? Interest on drawings. For Paisley, it is 650. And all the deductible items should be in the credit side. As you are deducting, it is meant for the partners only. So it is going to be added to the partners capital account. So interest on capital only for Paisley, which is 600. Salary 6,000. And share of profit. Share of profit. Profit share 5,925. Now you can finish up telling the current account. 15,075. 15,075. You will be now getting the balance carried on. The balance carried on in this case being 1425. Balance brought down also be rewritten the other side 1425. Hope now you will be able to understand this one. Question number 2. Samir and Punita are in partnership. The partnership agreement provides for the following: interest on drawings 5%, interest on capital 3% per annum. See, in case of interest on drawings, it's only 5%. So usually if per annum given, you have to calculate the number of months the drawings eligible for interest. Okay. Interest on capital 3%, salary to Punita 11,000, and profit shared in the ratio of 60 and 40. Okay, Samir and Punita, and prepare appropriation account for Samir and Punita and Punita's current account. This one also similar to the earlier illustration, carrying 12 marks. Pretty simple, right? So let me try to solve this one. Okay. These are the points. Now, profit for the year. We'll start with the profit for the year. P&L appropriation. Appropriation account. Appropriation account. Profit for the year. Profit for the year. 24,600. Don't forget to add interest on drawings on that. So here we have been given drawings. On that 5% will be applicable. For Samir and for Punita, 5% on this being 800 and on this being 620. 1420, 26,020. Less one after one. So we have to go for this one, interest on capital. Interest on capital for Samir and Punita. Interest on capital is only on capital account, not on current account. Be careful here. So on that 3% will be calculated. So 2,400 for Samir, 2,250 for Punita. Okay. On 75,000, 3%, 2,250. Then overall interest on capital being 4,650. And salary given to Punita, 11,000. So if I subtract 15,650, 10,370 is going to be shared. This is what about the share of profit between the two partners. Share of profit to Samir and Punita. Here 60% and here 40%. 60% on this being 6,222. Here 4,148. Then we have to prepare Punita's current account. Okay, current account. Punita's current account. Okay. As we bother about current account, I need to take only the current account information. Start with this one. So balance brought down. Whenever you prepare the current account opening balance should be posted here. Don't forget to immediately post the drawings in the other side. Otherwise, you will miss. Drawings for Punita being 12,400. And this value will come in the debit side. These are the values are going to be posted on the credit side. So interest on drawings. Interest on drawings. Interest on drawings for Punita being 620. And interest on capital for Punita 2,250 and salary to Punita 11,000 and profit share Punita 4148. Now tally and find out the balance. Total in the credit side 25,733. 25,733. And balance carried on here. 12,713. Rewrite here, balance brought down 12,730. Clear? Now we'll move on to the next one. This one also similar to the same model, but we have goods taken for own use is there. Farah and Salma are sisters who trade as partnership. Their partnership agreement provides for the following: interest on capital 2%, interest on drawings 4% per annum. 4% per annum. See, here we have been given 2%, 4% per annum. Earlier, it is only 5%. If this way the question is given, you have to calculate interest for the date of drawings to the date of closure of the books. Drawings for the year ended 28th February 2025. This is what about the year end, but drawn on this date. So for 14,250 at the rate of 4% from the December to February. January, February, only 2 months interest is going to be calculated. So you have to be careful here whether it's per annum or simply 2%. If it is simply 2%, you can directly apply. In case of per annum, you have to apply the period calculations also. And FARA is eligible for salary 11,200. And sharing ratio, residual profit and losses to be shared between FARA and Salma in the ratio of 30% is to 70%. Right. What are the accounts are going to be prepared? Appropriation account of FARA and Salma. And FARA's current account only to be prepared. Okay, FARA's current account only. Let's see. Now, we'll start with profit for the year. Profit for the year, which is 38,175. Don't forget to add interest on drawings on this. FARA and Salma. So for the interest on drawings for FARA, 14,250 and applicable rate of interest on that being 4%. You have to calculate only to the days applicable here from December to 28th February, only 2 months is there, right? So you have to calculate for 2 months into 2 by 12. Then this value being 95 rupees. In case of Salma, drawings also be the same. And that case, Salma, okay. Now this is not December. Probably October. You can stand corrected. Is it October? December. Okay. Yeah, okay then. No problem. So here 14,250 into 4 months into 2 by 12. 95. 95. Yeah, this is correct only. And one more drawings happening on 31st August. The value being 5,750. And for that 4%, but for this from August end you have to calculate interest. September, October, November, December, January, February. So 6 months interest is to be calculated. 6 months interest. Okay, I think it is 115. Overall value being 210. So here 210. So interest on drawings 305 will be addable with the profit for the year. 38,480 is the total amount is going to be shared among the partners. Now we'll start with interest on capital. Interest on capital minus interest on capital. FARA and Salma 2%. So you have to calculate 2% on 52,000, 1,040 and 75,000 into 2%, 1,500. Total 2,540. And we have been given salary also. The salary is applicable only for FARA 11,200. 11,200. And then the overall value being 13,740 is going to be subtracted. And profit to be shared here 24,740. I'm going to share this to these two partners, FARA and Salma. Profit share. Profit share. FARA and Salma. 30 and 70. First case 30, second case 70. Farah will get 7422. Salma will get 17318. So you get the total value 24740. Now you have to prepare current account for whom? Farah's current account. Farah's current account. Farah and current account. Under Farah's current account, never bother about the capital account. We have to start with current account of Farah and Salma. But I am going to prepare only for Farah, but the balance is credit. So it should be in the credit side. So balance brought down. If you supposed to prepare for Salma, debit, no, the value should be the other side. Okay. You have to be careful here. And once you complete this, immediately debit the drawings account here. The drawings here being these two. Okay, Salma no, Salma case. So Farah case only one, 14,250. 14,250. Apart from that, this will be debit side, these are in the credit side. So interest on drawings 95 for Farah. Interest on capital Farah 1040. Salary to Farah 11,200. And profit share to Farah. Okay, Farah 7422. Finish of tallying this 23,112. 23,112. You will get the balance carried on here. Balance carried on. 8767. Rewrite here as balance brought down. 8767. Okay. This one is over. Now we'll move on to the next question. Question number 4. Ali and Sai are in partnership. Their financial year ends on 30th June. Their partnership agreement includes the following items. Interest on capital is allowed at 6% per annum. Interest on capital 6%. Interest on drawings charged at 5%. If it is only 5%, no problem, you can directly calculate. In case, if it is 5% per annum, you have to apply for the days also. Okay, so here it's 5%. Sai settled to partnership salary, entitled to partnership salary 10,050. So salary is also be eligible for Sai. Not for Ali, only for Sai, 10,050. Ali and Sai share residual profits in the ratio of 3:2, the P&L ratio being 3:2. Profit for the year being 42,700. Ali provided a loan to the partnership of $10,000 at an interest rate of 5% per annum. The interest payment for the year ended 30th June 24 has been made. The partnership has no other loans. So here we have to make the payment for interest on this one, right? So 500% is 500 rupees. This 500 rupees, no, is not appropriation. So though the Ali provides a loan, being the partner, still it will be considered as payment made by Ali as a third party. So the payment by way of interest to Ali will be considered as a part of charge, means expenses. Expenses to be subtracted from the income statement, not appropriation. It is not appropriation. So if you prepare income statement, how do you prepare revenue and minus expenses? In that expenses, interest to partners loan will also be subtracted. After that only the value what you get is nothing but profit for the year. Profit for the year. Is that okay? In this case, revenue minus expenses being 42,700, interest to partners loan 10,000 into 5% 500 rupees, not subtracted. So then you have to subtract that one also to find out the profit for the year. The profit for the year is 42,200. Hope you'll be now able to understand. So this will not be part of appropriation. It should be adjusted ahead of calculating the profit for the year. So after subtracting the 500, the profit for the year for the calculation purpose is 42,200 only. Is that okay? So I need these particulars to prepare the required ledger accounts. What are the ledger accounts are to be prepared here? Prepare profit and loss appropriation account for the year ended 30th June 2024. Also prepare the capital account and current account of SAI. You have to prepare capital account and current account also. Okay. Now let's start. Income statement. Appropriation account. Appropriation account. Appropriation account. In appropriation account, we'll start with this one. So profit for the year. Profit for the year. 42,200. 42,200. Add interest on drawings. Interest on drawings. So on this value 5% for A for S. 5% on this being 550 and 5% on this being 800. Overall value being 1350. So if I add, so 43,550. 43,550 minus interest on capital. Interest on capital for A and B. So capital is given. So interest on capital being 6% for 60,000, 6% being 3,600. 40,000 for that 6% being 2,400. And 6,000 will be the interest on capital. And salary payable to SAI. So salary to SAI. SAI. Okay. This value being 10,050. Then if I add and subtract this total, 16,050 is going to be subtracted from the earlier income. 27,500 is going to be appropriated. Profit share. Profit share to Ali and SAI will be shared in the ratio of 3:2. 3 share of this 16,500 is for Ali and 2 share is for SAI. 3/5 and 2/5, 11,000. 27,500. Now you have to prepare the capital account also. Not only capital account, you have to prepare current account also. Capital account and current account. So what happens here? You have to prepare capital account and current account of SAI. Okay. SAI capital account and SAI current account. And SAI current account. Now, this is the capital account. We start with by balance brought down. Sorry, balance brought down. The value being 40,000 rupees for SAI. Of course, you can date it also. 1st July 23, balance brought down. And year end being the next year, 30th June 24. 30th June 24. Balance carried on. Balance carried on. Also being the same, 40,000. And rewrite here to the next side. 1724, balance brought down 40,000 rupees. Now we'll move on to current account of Sai. Current account of Sai being 250 credit on the same date 1723, balance brought down 250. Don't forget to immediately post the drawings of Sai on that same date. Okay, this will be for the year end. 3624 drawings. This value being 16,000. What more? This will be in debit side. These are in credit side. So interest on drawings should be in the debit side. Interest on drawings. Value being 800 for Sai. I confine with Sai only. So 3624, the year end only we go for appropriation. So interest on capital for Sai 2400, salary 10,050, profit share Sai 11,000. Now I can finish off tallying this. 23,700, 23,700, balance carried on 6,900, rewrite here 1724, balance brought down 6,900. Hope now you'll be able to understand this one also. We'll now move on to the next question. Question number 6. Aguila and Darius are in partnership. The partnership agreement provides for the following: interest on capital 3% per annum. Interest on capital 3%. Interest on drawings is only 5%, not per annum. Salary to Aguila 9,500 per annum. Salary. Residual profit and loss are shared in the ratio of 60:40. So 6:4 like you can write, or 3:2 like you can write. And profit for the year being $42,304. Okay. So you have to prepare appropriation account, current account of Aquila. Calculate the balance on Aquila's current account on 30th April 23 if he had been due $1,000 loan interest from the partnership. Okay, he had been due $1,000 loan interest from partnership. So the last content we will discuss later. So we'll try to finish up first two, as these things are similar to the earlier illustrations we have discussed. Now, profit for the year. We'll start with appropriation account. Appropriation account. Under that, profit for the year. Profit for the year being 42,304. And add interest on drawings. So this is being the interest drawings, and on that 5% will be calculated for Aquila and Darius. 5% on this being 970. For Darius it is 816. 1786. 44,090. Is that okay? Less. Interest on capital for Aquila and Darius. On their capital, 3% will be calculated. So for 93% being 2,700. For 65,000, 3% being 1,950. Overall value being 4,650. Salary payable to Aquila. Salary payable to Aquila 9,500. And the overall amount subtracted from this 44,090 being 14,150. If we subtract, then the ultimate value being 29,940 is going to be shared between Aquila and Darius. So profit share. Profit share for Aquila and Darius. 6:4. 60%, 40%. So A will get 17,964 and D will get 11,976. The overall value being 29,940. So now I'm going to prepare whose current account? Aquila's current account is going to be prepared. Aquila's current account. Aquila current account. In that, never bother about the capital account. We bother about current account only. Now the balance is 2,600 debit. So the value should be posted in the debit side. Balance brought down. And don't forget to add the drawings immediately in the debit side. Post that in the debit side. Drawings. 19,400. This value should be in the debit side. This value in the credit side. So interest on drawings. Interest on drawings. For Aquila 970. And thereafter interest on capital share, salary and profit share for Aquila is going to be posted. Now interest on capital. Interest on capital 2,700 and salary to Aquila 9,500. Profit share 17,964. If we tally this, 30,164. 30,164. You'll get the balance carried on here. So we started with the negative balance but ended with positive balance. 7194. Rewrite here as balance brought down. 7194. Is that clear? That's one more variation. The last question. Calculate the balance on Aquila's current account if he had been due of 1,000 loan interest from the partnership. Suppose partnership firm has to pay to Aquila. Okay. Okay. Interest on loan being 1,000. What could be the impact in Aquila's current account? Okay, in this case, the balance before this adjustment in Aquila 7194. Am I right? If she gets another 1,000 rupees from partnership for interest on her loan, 1000 will be increasing, provided this should be subtracted from here. Am I right? This is not an appropriation, so the charge and expenses to be debited or adjusted in the income statement. 42, 300, 304, from there 1000 is subtracted. If you subtract 1000, this value also be decreased to 28,940. Means you have to reduce 1000 rupees. If you reduce 1000 rupees in the ratio of 6:4, A will get 600 rupees lesser, B will get 400 rupees lesser. Am I right? As 1000 rupees is reduced here, this will also be reduced here. Finally, the amount distributed to these two partners will also be reduced by 1000. In that 1000, A's amount to be reduced is 600. So, minus reduction in profit share. Reduction in profit share being 600. Then the ultimate value here being 7594. Clear? This is a rectification of error like, okay, correction of error like. Clear? Now let's try this question. John and Bonu are partners. Sixth question. The partners provided the following list of balances at 31st March 2021. And you are required to prepare complete income statement in this illustration. Later you have to go for appropriations. It's a comprehensive illustration. As I already told you, you have to prepare income statement before this appropriation. So this is the first step, this is the second step. Usually we come across with these two only, profit and loss appropriation account and partners capital account only. Okay, some advanced level problem we include this one also and this one also. Okay, so now this illustration, question number 6. Here we have been given what? Complete details. From there you have to prepare income statement as well as appropriations both. Let's now start. Okay, the available information, this one. Then further we have this information also. So you have to prepare income statement first of all. As per the information you studied in financial statements chapter, we have to prepare here. So we have been given the inventory here. Rates of 650 were uploaded at 31st March 2021. Right. Maybe unpaid. Okay, maybe unpaid. So unpaid should be addable with the rates. So you have to add 650. Inventory, closing inventory being 9,200. 9,200 being closing. Commission receivable $300 was due. This becomes receivable outstanding. Still we have to receive 300 rupees excess. Already we have 4,800. With that another 300 rupees should also be receivable. Income. Depreciation on fitting is to be charged at the rate of 15% per annum using straight line method. Depreciation. Okay, fittings. On this 15% will be your depreciation. So the first 4 information is for the preparation of the income statement. Thereafter this will be for sharing, appropriation. Interest on capital, interest on partners loan being 5%. Partners loan is not appropriation. It's only a charge. Partners loan. John being one of the partners, and his loan carries interest at the rate of 5%. This will also be a charge or expenses, not appropriation. Interest on drawings is an appropriation 6%, and interest on capital 3%, appropriation per annum. This is 3% per annum. And salary to John 8,500. Salary to John 8,500. The items recorded in green color is for appropriation. And profit and loss shared between John and Bonu in the ratio of 40%, 60%, otherwise 2:3. Okay, you can cancel this, and 4:6, otherwise it is 2:3. So 2:3 is the ratio. We'll start with income statement, trading section, and income section. Revenue, income statement. Revenue. Revenue being 1,58,000. And inventory, you have to subtract cost of sales. In that, opening inventory 9,400. Add purchases 69,200. 78,600 minus closing inventory 9,200. Then material cost being 69,400. Do we have any other production related expenses? No. We have one more income, should also be incorporated. So you'll be getting gross profit. Gross profit in this case being 88,600. Add other income, commission receivable 4,800. With that you have to add another 300 rupees, so 5,100. Then total revenue being 93,700 less expenses. Rates and insurance. The value being 11,250, and you have to add 650 with this. Then this value being 11,900. Wages, no adjustment, 10,475. General expenses 9,674. Discount allowed also expenses. Discount allowed. This value being 2,000. Commission receivable being the income already posted. Balance at bank asset. Trade receivables asset. Liabilities, premises at cost asset. Fittings at cost asset, but it carries 15% depreciation on cost. Cost 18,000 rupees. On that depreciation at the rate of 15% should be calculated. So depreciation on fittings 15% on this being 2,700. Loan from John. Okay. On that interest is applicable. Interest on partner's loan. On this 5%, 500 rupees will also be deductible. Okay. You can show it separately also, no problem. Okay, the total expenses here being 36,750. If I subtract this one from here, profit from operation being profit from operation before interest. Before interest, we call this being profit from operation. 56,950 minus interest on loan. Interest on loan. For the 10,000 rupees, 5%, 500 will be subtracted. The value what you get is here is called profit for the year. Profit for the year. Profit for the year here being 56,450. Now we'll start this for appropriation. Second part. Profit for the year is a starting for us 56,450. Add interest on drawings. Interest on drawings. So drawings carry 6% interest. So for this value, 6% will be calculated for 19,000 6%. 1140 for John, 1140 for Bonu on 21,000 6%, 1260. The overall value being 2,400. 58,850. 58,850. And less interest on capital for John and Bonu. Will not calculate on current assets, current account, only on the capital accounts we are going to calculate at the rate of 3% on this value. 2,250, and for 50,000, 1,500. 3,750. Salary payable to John. Salary payable to John. 8,500. The total value being 12,250. If I subtract, 46,600 will be the final value. Now you have to share this to the two partners. Profit share. Okay. Profit share for John and Bono in the ratio of 2:3. 18,640. 2 share for 3 share 27,960. 46,600. 46,600. Okay. So here we have now understood how can we link income statement with the profit and loss appropriation account. So appropriation account, right? The profit what you have found out will be now appropriated to the partners. In the next question, it's a pretty different, where you have to prepare appropriation account and then the balance sheet extract. Okay. Question number 8. Question number 8. Prepare profit and loss appropriation account for Sian and Tom for the year ended. Okay. And current account. Prepare extract from the statement of financial position of Sian and Tom that shows capital accounts only, and the full details of their current account also be shown here. Okay. Now, question number 7. Interest on capital is allowed at the rate of 6%. This is drawings for interest on capital 6%. Sian allowed a salary of rupees 20,000 rupees. 20,000 being salary. $20,000. Interest on drawings is charged at the rate of 3% per annum. 3% per annum. This is drawings. This is capital. And then profit for the year before appropriation, $59,190. Okay. I just copy the required data only. Okay, drawings and capital. Further, we have been given current account. This is current account. Okay. So you have to prepare appropriation account and then balance sheet extract showing the capital account only. Let's start. Appropriation account. Appropriation. Appropriation account. Profit for the year. Profit for the year. 59,190. And you have to add interest on drawings. So here drawings is given and year end being 31st March 22. Then for this it carries full year's interest, but for this 3% only from October onwards. You have to calculate only for 6 months. Am I right? So I will calculate here separately for Cyan. For the 8,000 rupees, 3% will be applied. For the another 6,000, 3% for 6 months is going to be calculated. First case 240, second case 90, the total value being 330. This is for Cyan. Cyan 330. In case of Tom, for this 10,000 into 3%, 300, and for this 12,000, interest will be applicable only for half year, 6 months, 6 by 12, 180. The total being 480. 480. 480 is for Tom. The total interest on drawings for both the partners being 1810. 60,000 is the total value. Minus interest on capital. Interest on capital. Cyan and Tom. Interest will not carry on current account, only the capital account is eligible for interest. 6% on 1,50,000, 9,000 rupees. 6% on 1,06,000 rupees. Overall value being 15,000. And then salary to Cyan. Salary to Cyan. This value being 20. Salary to Cyan 20. 35,000. If I subtract 35,000, then 25,000 is the profit for the year to be shared. Profit share. Profit share for S and T. In what ratio we have to share this? Okay. Sharing profits and losses in proportion to capital invested. The capital invested by the partners being 1,50,000, 1 lakh, otherwise 1,50,000 is to 1 lakh, otherwise 15 is to 10 or 3 is to 2. 3 is to 2 is the ratio. So this 25,000 will be shared in the ratio of 3 is to 2. Cyan will get 15,000 and Tom will get 10,000. 20,000 rupees. 25,000 rupees. Is that okay? Now we have to prepare the extract of balance sheet, especially capital account. I'll prepare here. In the balance sheet, statement of financial position. Financial position. Capital account. Okay. For Shian and Tom, the original capital account here being this one, 1,50,000 and 1 lakh. Not only that, we have to show current account separately. Current account. In case of current account for S and for T, usually you prepare current account now with various credits and debits. Means this will be the debit value, this will be the credit value. You keep the same thing in your mind and post that. This will be subtracted and this will be added. That's all in that opening value. So opening current account being here, opening value, opening balance. Sian 3,000 and Tom 7,000 debit. I represent that in brackets. Debit balance. What to be added? First you have to subtract what? Drawings should be subtracted. Minus drawings. Drawings being Sian 14,000 and Tom 22,000. Similarly, you have to subtract interest on drawings. This one 330 and 480. And you have to add what? Interest on capital, salary and profit share. Interest on capital. So I put all the values in bracket representing deductible item, not to confuse. Interest on capital 9,000 and 6,000. Salary payable to Sian 20,000. Profit share 15 and 10,000. 15,000 and 10,000. The total of S being 32,670. And in case of Tom, 13,480 negative. The total value being 19,190 in the outer column. Then overall capital here being 2,69,190. Hope you will be now able to understand how to incorporate the normal current account and capital account in a statement of financial position. Is that okay? Tadin and Edith are lawyers who have been in partnership for many years. Trial balance is given. Rates and insurance include an amount of $1,920 for the year 1st March 24 to 28th February 2025. We are according for which year? Year end 30th April 2024. Then it is not matching for the period. Okay. So you have to adjust this one here. Rates and insurance. So this 1,920 is from 1st March to 28th February. 28th February 25. But our year ends on 30 April 24. So this is for 12 months. but the amount matching for the current period is only 2 months, March and April last, and this is not matching. Out of 1920, 10 months value out of 12 months not matching, this value being 1600. It is nothing but advance amount should be subtracted. As this being the advance should be subtracted from here and also be an asset, as the amount is paid in advance is an asset. Okay. So minus 1600 and this becomes your asset, current assets. Yeah, of course you can use cross division method also as you wish, no issues. Right, 1600 being the current assets. This is being the current assets. Also being current assets. I name this being current asset. And at 30th April 24, $1,800 for salaries was due but unpaid. That's an unpaid. Outstanding should be added. In salaries, there is an outstanding. Add 1,800. Amount remains pending being your current liabilities. Okay. This is current liabilities. Add 1,800. This is current assets. Subtract 1,600. Irrecoverable receivables 670 are to be written off. Irrecoverable debt from the debtors. In receivables, you have to subtract this value. 670 will be subtracted. Irrecoverable debt. Irrecoverable debt. Expenses. Depreciation on fittings and equipments is to be charged at the rate of 15% per annum using straight line method. Depreciation under straight line method. Fittings. So, depreciation, you have to subtract 15% on this. The partnership agreement provides for interest on partners loan 6%. Interest on loan will be part of expenses, will come under income expenditure, income statement account, income statement, so 6%. So here 6%. Interest 6%. Interest on drawings 5%. This is an appropriation item. So for the drawings 5% will be applicable. Interest on capital 3% will be applicable per annum. Salary of Yardit 10,000 per annum will be payable. Salary Yardit, only for Yardit, 10,000 will be applicable. Now the residual profit and loss will be shared between these two partners in the ratio of 60-40, otherwise 3:2. 3:2. 3:2. Okay. Now I am going to prepare all the requisite statements. Though you have been asked to prepare income statement, appropriation account only, but anyhow I prepare income statement, appropriation account, capital account as well as financial position statement also. I will prepare comprehensively here. Okay, for the better understanding. Now we'll start here. Income statement. Income statement. Financial position. Appropriations. So a comprehensive illustration. Income statement. Okay. Appropriation account. appropriation statement or account, and capital account, current account though not required, but I prepared that one also. And financial position statement. Financial position statement. Okay, you can prepare comprehensively here. I'll finish off writing the basic format: revenue minus cost of sales. Under cost of sales, opening inventory plus purchases minus closing inventory. And if you subtract this item, cost of sales, from revenue, you will get gross profit. And you have to add if there is any other income with that, and your expenses will be subtracted from here. This is the format. In case of appropriation account, you will calculate profit for the year. You know that will be the starting point here. Profit for the year. I start that as a opening value here. Profit for the year. Okay. Then add interest on drawings for T and Y. Minus interest on capital for T and Y, and then salary payable to Y only. If you subtract, then this will be profit share between T and Y. Profit share should be in the ratio of 3:2. In case of capital account, we have two partners. No, most of the examination question asked to prepare the capital account for only one partner. But for the comprehensive understanding, I will prepare both the partners' capital account here in columnar form. Capital account and current account. In columnar form. Because the debit and credit values are same, I may have two columns. One column is for partner T, another column is for partner Y. That's how we can prepare. In most of the cases, the debit side as well as credit side will have the same debit account and credit account. So you can prepare this way. One is for T, another one is for Y. And in this format, what will come? Balance brought down. Here, balance brought down. And in current account debit side, we start with the drawings, interest on drawings. Here, interest on capital and salary, if any, profit share. These are the items will come. You will get the balance carried on. Rewrite here as balance brought down. This one also you can tally and get the balance as usual, but anyhow we have no other transaction. I'll keep it as it is. Now we'll go for financial position statement format. Financial position statement. Okay. Now, in case of financial position statement, balance sheet will start this way. Assets, we'll start with the assets. Non-current assets, tangible, non-current assets. And current assets, if we have intangible, we can post that one also. And current assets, non-current assets and current assets. Then capital and liabilities. Capital and liabilities. Under that, capital for T and Y, current account for T and Y. Then we have non-current liabilities, non-current liabilities and current liabilities. Current liabilities. So I've completed full format here. See, if you have been given this like an account format, you have to post once any adjustments related to any item here, current liabilities and this one, it should be posted twice. So keep that idea in your mind so that you will finish up without any hiccup. Let me first try to finish up to this one. Premises at cost. Parallelly, I am posting all these six wherever it may be applicable. Yeah, let's start. Revenue 2,36,350. Salaries, being the expenses, will be posted here. Salaries. This value being 79,800. With that, 1,800 should be addable. 1,800 should be addable. Then the ultimate value being 81,600. And this 1,800 is again current liabilities. I have to post that in the current liabilities account section. Okay. Outstanding salaries are other payables. Other payables. The value being 1,800. And rent, rates and insurance also be expenses. Rates and insurance. The value being 17,320 minus 1,600 paid in advance. If I subtract, then the rates and insurance should be 15,720. 15,720. That the payment being in advance as an asset will be posted in the current assets account. Okay. So here, other receivables. This will be other receivables. Other receivables. This value being 1,600. Advertising, also one more expenses. Advertising 16,730. We don't have any adjustment. Office expenses 6,150. Interest on loan from Tadin also be expenses here. Interest on loan 1,200. Okay, so here is. Then premises at cost in non-current assets. Premises. This value being 1,80,000. 1,80,000. Now, See here, we have completed up to this premises at cost posting. 3 more items are going to be recorded. Fittings and equipment at cost. Fittings and equipment at cost. Fittings. Cost being 70,000 and provision for depreciation on the fittings being 31,500. And now you have to create another 15% on 70,000 rupees. If we calculate 15% on this 70, that value being 10,500. Should be subtracted from that set fittings and it will be an expenses. So I post that here. Depreciation on fittings. This value being 10,500. 10,500. And receivables, current assets, their receivables, the value being 24,200. There is an irrecoverable debt 670 should be subtracted from here. After subtracting, what is the final value? 23,530. 23,530. And that irrecoverable debt not only subtracted from here as is being the adjustment item should be posted again. Here as well as it's an expenses should be posted here. Irrecoverable debt. Irrecoverable debt 670. So you have posted all these items here. Then this one. I'll pick from here to here. Cash at bank being the current assets. Current assets. I need space, so I adjust here. And bank balance. Bank balance and the cash balance. Bank balance being 19,335. Cash balance being 1,375. Loan from Tandem, we assume this is being non-current liabilities. Tandem loan. Tandem, okay. It's a Tadin, okay. Tadin loan. Tadin loan, 20,000 rupees. Non-current liabilities like we can assume. The loan from Tadin carries 6% interest. You no need to do any adjustments because that 6% is already calculated and included here. We assume that the adjustment is already over. You no need to worry about this adjustment. You no need to worry about that now. Okay. Now, we'll start with the interest capital account first. Let me finish up this block. Capital account. Capital account for Tadin, the balance being 1,25,000. And for Edit, 85,000. And now we have to calculate interest on that. Okay, interest on that. Interest on capital Tadin 1,25,000. The interest carries 3%. So 3% on this being 3,750. Edit 85,000 to 3%, 2,550. And Edit is eligible for salary also. Salary for Edit, which is 10,000 rupees here. Okay, so I have posted this item. Next we will go for the current account information to be posted. Current account. Tadin 3,300, Edit 4,240, 3,300, 4,000, 4,240 here. 4,240 here. Is that clear? And in case of drawings, 34,300 and 46,500. Drawings 34,300 for TAD and edit 46,500 and interest on that being 5%. 5% on this being 17, 15, 23, 25. 23, 25. Right. Now what business is this? Lawyers. As it is being the lawyers, we don't have the stocks. You can skip this. We don't have the stocks case. Okay. Now this one, from here I can subtract directly this full value. Income statement. 2,36,350 as being the lawyer. This will not come. I am not seen, but after seeing that only realized it's a lawyers. Lawyers firm will not have any stocks. The total value of this one. Okay. Now this interest on loan can also be treated the other way. I'll show you. Also be subtracted, but finish off subtracting this value first of all. 1,31,370. This total is subtracted from here. You will get 1,04,980. Now you can subtract that interest on loan. Because I am going to differentiate. Before subtracting interest on loan, the value I get here is called as profit from operations. If you don't show it separately, of course, profit for the year will be the same. There will not be any impact. 1,200 is subtracted, so 1,03,780. 1,03,780. This 1,03,780 becomes amount of appropriation, amount for the appropriation, so 1,03,780. 1,03,780. Interest on drawings already we calculated, so 17, 15, 23, 25. Overall value being 40, 40. Then overall revenue for appropriation being 1,07,820. And total of interest on capital and salary all put together being 16,300. The amount meant for appropriation being 91,300. Should be apportioned between these two partners in their ratio 3:2. T will get 54,912. Y will get 36,608. Now, while preparing capital account, there will not be any change. The opening balance remains same. In current account, I have to post. This one will go to the debit side. This will go to credit side. The debit side item was already posted. Interest on drawings, only credit side item. Interest on capital, 3,750 for T, 2,550 for Y. And salary is only for Y, 10,000. Profit share being 54,912 for T, 36,608 for Y. Right. Now if you tally, then what's the balance you are getting? So this number is 91,520. 91,520. And current account, in case of add it shows in the debit side, means negative. So for add it, I have to post that value in the other side, 4240. Balance brought down. Not here, not here. Okay. Now if I tally this for T, if I tally this for T, the total being 61,962, 61,962, balance carried on being 25,947. In case of Y, the balance in the debit side is higher, so 53,065 and 53,065. Balance carried on being the negative balance 3907, 3907. So balance brought down, 3907, 25,947. Now here in capital account, this premises being 1,80,000, 70 minus these depreciation is subtracted to find out the ultimate value 28,000. And current assets. Under that we have been given 4 items. The total of these 4 items being 45,840. If I total up all these values, this will be 2,08,000 non-current assets and current assets. Total being 2,53,840. Capital in case of T and Y 125 and 85 ends with 2,08,000 rupees. And current account for T 25,947 positive value. For Y it is a negative value 3,907. If you add up these two, then the value being 45,840. Sorry, 21,800. No, 22,40. Non-current liabilities 20,000. Other payables 1,800. If I add up all these things, the total being 2,53,840. It's matching with the assets. Instead of posting that in a detailed working, you can post all these value here, and from that you can subtract this. That way also you can show. Rather than preparing the current account, you can show that under balance sheet, means financial position.